Head of Research at United Capital, Wale Olusi, joins us now. Good morning, Wale. Thank you for joining us and Happy New Year to you.
Good morning. Thank you for having me. Happy New Year.
Now, the World Bank expects growth in Nigeria to resume at 1.1% in 2021, that's this year, but you see a 1.7 to 2% growth. However, the federal government expects a 3.2% growth. What for you is driving this optimism?
Okay, thank you for having me once again and Happy New Year. Well, I don't think it's really an optimism per se, because if you look at the Nigerian economy and its capacity, it's an economy that can do more than 5% growth, if things are actually, very normal and the normal policies are in place. But at 1.7%, what we are seeing is a situation whereby an extremely low base effect from last year's economic recession is going to, help the economy rebound in 2021. Again, we are also seeing improvement in oil prices, which hit a record low of about $20 to $18 per barrel last year. And then, the most of the economy is going to be, rather opened 2021 compared to 2020. So if you look at how, all of these factors, are pulled together, we think the economy might be able to rebound by about 1.7 to 2% in 2021 because of that low base effect from last year. I mean, last year at minus 6% in Q2, that was the lowest level the Nigerian economy has ever reported a decline. So that should be able to pull the economy up 2020.
Okay. So Wale, we've seen some improvement in the oil market, but let's not forget it's a volatile market. And of course, Nigeria, being an OPEC member, is guided by the quota. Nigeria's oil production has fallen currently at 1.6 million barrels per day. Shouldn't that be a concern?
It is a concern, but the truth actually is that oil accounts for about 10% of the Nigerian GDP. If you look at what the MBS is using to calculate the GDP, oil is about 10%. But the significance of oil is really about the, FX earnings. When oil prices improve, the sentiment for the Nigerian economy improves. Typically, foreign investors look at Nigeria differently when oil prices are improving. So yes, there's a lower production. If you put that against the oil price, it may not be able to, pull the economy out significantly. But the central bank gets more FX, the external reserve improves, then it feeds into other critical sectors such as trade, such as manufacturing sectors, which are also, significantly affected last year. Now, when FX earnings improves, you start seeing improvement in manufacturing activity that depends a lot on importation. Trade activity also starts improving, and then manufacturing and trade alone, or the services sector put together, account for more than 60% of the economy. That should be able to allow us, rebound. Now, I need to state clearly, 1.7%, 2% is not where Nigeria should be in terms of growth. If you compare that to growth per capita income, that is growth per head, this economy is still struggling. So, 1.7 is not really growth. What we need is growth that is, at least mid-single digits for us to start seeing Nigeria the way we want it to be.
All right, Wale, let's look at some other concerns as raised by the World Bank. Talked about falling public investment due to weak government revenues, constrained private investment due to firm failures, and of course, subdued foreign investor confidence. So how can Nigerian economy transition into an investment-led economy in the midst of all of these uncertainty?
I mean, really, it's really about the policies we put in place and the kind of impression we are creating in the mind of, foreign investors, who want to come and invest into this economy. I think if the policies are right, for example, the FX markets remain, technically inactive for going to about 10 months now because, if you look at what is happening in the I&E window compared to pre-COVID level, that market is not really opened. FDI, was able to increase slightly in Q3 of 2020. But if you look at it, it's still at very, very record low. In the last 3 to 4 years, FDI has, continued to average about $2 billion. Before then, it was way more than that. Most of the foreign investment that we see in Nigeria are mostly hot money, what you call foreign portfolio investment. They only come in and exit immediately. FDI will not come if they don't think the policies favor their investment. So we need to look at critical sectors of the economy, such as the power. And I think the government have started doing, things. As of last year, the pandemic actually forced us to take some critical reforms in for example, the oil and gas sector, where the downstream sector seems to have been, deregulated now. Pump price have gone to 158 or thereabout. If you look at the electricity sector, the government is also taking critical steps there to make sure that tariff, reflects the cost. And once, that sector becomes profitable, you'll be able to attract more investments into that sector. But we need to also look at other sectors, such as the agri. I think, a more holistic approach really needs to be taken to look at that agri sector. The sector has continued to report, on the average in the last 5 years, about 3% growth. Last year was about 1.4%. Now, for that agri sector with a lot of potentials, we need something more holistic, something more far-reaching. That sector should be reporting growth above 7%. Nigeria will account for over 5%. So, we need to look beyond oil, yes, but we need to take bolder steps across the sector. The manufacturing sector is another sector that we need to look at critically, and we need to create a lot of jobs for Nigerians.
Okay, so looking at the 2021 budget, how much impact do you think it will have on our recovery efforts?
Well, the 2021 budget is bold. Government wants to spend about 13 trillion. It has been passed as at the 31st of December, which is laudable, by the way. And of course, the Finance Act has also been, passed along with it. Yeah. Our own challenge is the fact that government wants to raise the revenue of about 7 trillion. We struggle to see where the revenue is going to come from. Most of the revenue estimates for both non-oil and oil over the last couple of years have consistently underperformed, their estimates. So the only challenge really is where the revenue is going to come from. But I think the intentions are right, but the revenue needs to come from somewhere. Last year, when the Finance Act was initially launched, all of those non-oil revenue assumptions were all reviewed so that government can mobilize non-oil revenue aggressively. But with the pandemic, it affects corporate earnings. It also affected oil revenue. And, most of the year, budget performance was considerably below estimates. So we think, that might also happen this year. So we think fiscal efforts should continue, but most of the spending will probably depend on whatever we can raise in terms of revenue, and mostly on borrowing.
All right, Wale, before we let you go there, the Central Bank's Monetary Policy Committee will be meeting later this month, the first one for the new year. What is your expectation? What sort of responses are you hoping to see?
Well, thank you for that question. We think the monetary policy, based on the last meeting they had, clearly are concerned about the, recession that we saw last year. And they've supported central bank's heterodox monetary policy to keep interest rates low. The intention of that is to make sure that, there's enough liquidity in the system, there's enough borrowing going on among the corporates so that consumption can also improve, so that growth can come back. We think in the next MPC meeting, they will review their, decisions at the last meeting. We think, the galloping inflation will be a concern for them. So, our suspect is that they may want to keep, policy variables at current level for now, or maybe in their March meeting, they may begin to look at how they will start tweaking policy variables to, support maybe faster growth, or recalibrate inflation rate that has been, jumping almost over the roof, so that it can come back. And that might mean that they want to change their decision to keep increasing interest rate, because inflation rate at about 15% does not support growth.
Yeah.
They need to look at that critically.
All right. Thank you very much, Wale Olusi. We do appreciate your time always. Thank you.